Hey everybody, what's up? Monday! I just sent out the new issue of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial. Alright, so what happened today? Stocks. Dow was actually up. I mean, we were down around 200 points overnight and close to that during the day. Dow Jones settled slightly positive. S&P down about 0.25%. The big drop was in the NASDAQ on a bunch of news that could impact the big name tech companies, Google, Apple, etc. That was some regulatory news that developed. Also, Amazon could be a subject of that regulatory scrutiny. So, and of course, the ongoing trade war issues, etc., etc. Gold had a very big day, up about 20 bucks at the highest level now in 2 months. And the dollar was weaker. What's interesting about the dollar is, and I spoke about this in today's report, this is really the first time, and it goes back, I think you can correlate this with Trump's threat to impose tariffs on Mexico. This is really the first time that we have seen the dollar weaken in response to an expansion of this trade war situation. In the past, year, 15 months, all of these inflammatory trade remarks have resulted in aggressive buying of the dollar. We have seen that time and time again. But since the Mexico situation, the dollar has responded negatively. Now, maybe that's just coincidence. Maybe that is telling us something. As far as I could see from headlines and commentary, people are saying, well, this increases the likelihood or the prospect that the Fed is going to cut rates. But that expectation has been embodied in the futures markets now for quite a bit of time. I mean, if you recall, the Fed ended its rate hikes in January. It went on to say it will end balance sheet roll-off in September. And Fed fund futures had been pricing in rate cuts as early as, I believe, October of this year, and that has increased. The probabilities have increased, but the expectation for rate cuts now has been embedded in the futures market for some time. So to say that the dollar is falling because it increases the likelihood, now the likelihood of a Fed rate cut has gone up, maybe that's what is motivating dollar selling right now. Maybe it's something beyond that. As you know, my position now for the last 12, 15 months has been that the dollar rally has been a rally in a bear market. Remember, the dollar index peaked out in January 2017 at 103.80 something. It traded all the way down to 88 in February of last year, February 2018, and then it bounced up to a little over 98. So that was a 61.8% Fibonacci retracement. A lot of people look at those Fibonacci numbers. I look at them just from the standpoint of having an idea what other market participants are looking at. But fundamentally for me, the dollar has been in a bear market. Fiscal expansion, the Fed rate hikes certainly, although I would say that the pause in the Fed rate hikes in January, that was a signal to probably close out short dollar positions or go long as a trade. I held on to the dollar shorts because I still believe that the fiscal outlook and the trade outlook, with US running larger and larger trade deficits, were a long-term bearish factor for the dollar. So I stayed short. You could have made a play on the Fed pause in January. That would have been a nice little reversal trade there, but I stayed short. It's more of a macro trade for me. And it's also interesting with gold. Now you could make the case that gold is reacting to, fear, a flight to safety, some people perceive. Don't forget, last month gold was now accepted as a tier 1 bank asset. All right. So that could be a factor, at least for some buying. But it's interesting now how the dollar and gold are reacting positively, or I should say the dollar negative and gold positive, in this expanded trade war environment that we are in. Whereas before, those announcements and those threats and the tariffs and everything else led to a decline in gold and a rally in the dollar. So something flipped around. It might be a temporary situation, but for now something flipped around, and it looks pretty robust. It looks pretty strong, these impulses. So you have that. We have now come to the period from now through June where, as far as bank reserves are concerned, we are going to start to see once again a decline in reserve balances. We peaked out at the end of May, just concluded. Now the month of June will see a decline in reserve balances. What does this mean? By the way, before I even get into that, let me just mention that the data, once again, in the MMT Trader Report, which I went over thoroughly, and it's presented each facet of data is in there. No indication in any of the fiscal situation, tax revenues, unemployment benefits, food stamps, for example, anything which you would consider or look at as a barometer of the economy, which would be on the front line, which would weaken to tell us that things were starting to go south, covering the period of most of May, where we had really, Trump's first tweet about China on May 5th when he said the deal is off, and all the correction in the stock market that we have seen up until the end of May. Nothing in that leading data, and not just the fiscal, in bank credit, in loans and leases. We have some of the bank metrics which are just blowing through the roof. We have real estate loans at an 8-month high now that just went through a very rapid acceleration. We have auto loans that have been up for 21 weeks in a row, not even the slightest dip, 21 weeks in a row up. And similar indications in that in the bank credit, bank assets, all those things have been growing, they've been expanding. If the economy was really slowing down, demand for credit demand is on the front line. You would really start to see that. And just to give you an idea of what I'm talking about, when the government went into shutdown mode back in, January, we saw that immediately manifest in those numbers. So those numbers tell you right there, they're on the front lines of the economy. That's the barometer. And there is no indication in those numbers whatsoever of any sort of downturn or weakness. As a matter of fact, most of those things are accelerating. Most of those things are at all-time highs. So I have to go with that, because that, to me, you don't get any more real time. You don't get any closer to the real economy than what you see in those numbers. So take it for what it's worth. Anyway, if you want the full breakdown and the full analysis, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye-bye.